FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video as we continue our Blueprint Summit videos, as I continue to share my strategy that I use every single day to trade the markets. In this particular video, we're going to go ahead and break down the entry triggers for each individual trade setup. So guys, if you're liking this particular Blue Summit series, do me a favor, give me a quick like on the video, subscribe to the channel if you're not subscribed, and without further ado, let's get this started. All right, so let's get into the entries and exits of these specific patterns. So let's go ahead and talk about the entry triggers for type 1 setups. So the first thing is, for type 1 setups, there must be a stop hunt that moves above or below the Asian box, right? That has to be there. That's a requirement. Because if not, then it's not a type 1. Second is, you must have an M or W pattern being formed, right? That's because we don't trade one-legged patterns, right? So there's got to be a type 1 M or W pattern being formed. We don't trade one-legged patterns. The second leg of the M or W must either be in the London or New York box. We don't take any trades in the Asian session. There are no setups, no trades that we take in the Asian session. All of the setups happen either in the London or New York session. That's it. You must have 5 or more candles between the first and second leg. Why is that? Because we know, based off of back testing, that when you have patterns, M or W patterns, that have at least 5 or more candles between the first and second leg, the winning percentage is well over 80%. Are there going to be M's and W patterns that you see that have 5 or less candles between the first and second leg? Absolutely. Will some of those trades work out? Sure. But because we're trying to do this over an extended period of time of years, not a week or month, we know that the majority of the actual good trades that we want to trade have 5 or more candles between the first and second leg. If the second leg gives you a railroad track, a star pattern, or a quarter wood, you can enter the trade early. If you don't get that pattern on the second leg, so meaning if you don't get a railroad track, a star pattern, or a quarter wood on the second leg, then you wait for either a close of the 13 EMA, so price basically to close above or below the 13 EMA, or you wait for the 13 and 5 EMA crossover. I'm going to show you what all this looks like on the chart so you know exactly what I'm talking about. So the difference that we found in trading a pattern that closes below or above a 13 EMA, and then a trade setup that you wait for 5 and 13 EMA crossover to get into the trade, is typically about a 1 candle difference. So you're getting in ahead 1 candle. It works out to be 1 candle. So it really depends on whether or not you're an aggressive trader or not. And so you kind of have to determine yourself, you know, are you the type of trader that's aggressive, or are you more reserved, conservative? And that's more of a personality type of trait than anything. And lastly, you always wait to see if you get a pullback before you enter the trade. What does that mean? It means that after you get the railroad track, if you get a railroad track on a second leg, the next candle, you wait to see if there's any pullback at the beginning of that candle. The reason that you do this will be because you could save yourself more pips on the stop loss. But yeah, so always wait to see if there's a pullback. It doesn't matter if you're getting in after the railroad track or 13 EMA close or 13 and 5 crossover. So either way, just wait for the pullback. Trust me, it'll pay off. Are there times when you're not going to have a pullback? Absolutely. It's perfectly fine. But at least you want to try and see if you get a pullback to get a better entry. Because sometimes these railroad tracks or these star patterns are freaking 25 pips long or 25 pip big candles. You can't tell me that you're going to have a 25 pip stop loss on Euro USD. That makes no sense. So if you have a pullback, though, now you have a chance. So, type 2 entry triggers. Simple. Price action must be stuck at the top or the bottom of the Asian range, like I showed you on the whiteboard. Same thing. You must have an M or W being formed to make a trade. Same thing as before. We don't trade one-legged patterns. Same thing. Second leg of the M or W must be either in the London or New York box. I don't care where the first leg is, as long as the second leg is in London or New York box. That's all you care about. If the first leg is in Asia, then we look for the second leg to be in the London session open. That's when I talked about typically happening before 4:30 or so. Same thing here. We don't take trades during or in the Asian session. We don't care about taking trades in that session. Because if you look, during the Asian session, I'm sure there's probably going to be M's and W's back and forth all over the place. But we don't take any trades in that Asian session. Same thing, you want 5 or more candles between first and second leg. This just ensures that you get a good entry. You'll see why when we go over to the charts, because at 5 and 13, when you get a strong push in one direction, they start to separate, and it takes time for those two to get closer to each other for the entry. So having the 5 or more candles in between the first and second leg allows you to have the entry that you want. Same thing as type 1s. Second leg gives you a railroad track, star pattern, or cow you can enter early. If not, same thing as type 1s. You're waiting for a close above or below the 13 EMA or 5 and 13 crossover. And same thing as type 1s. Always wait for the pullback to enter the trade. Type 3 triggers. So price action must come from the top or bottom and get stuck in the middle of the range. Right? We want these type 3 patterns to come from the top or the bottom and get stuck in the middle. You got to start questioning yourself. If price comes from the top or the bottom and it gets stuck in the middle, why? Why is it getting stuck in the middle? Type 3 patterns will, most of them will produce a one-legged pattern that pins to the middle of the Asian session. We look to have a 50 EMA pin as a form of confirmation. So very likely most times you're going to get a pin or price action pinning to the middle of the Asian range, but also it's pinning to the 50 EMA. Sometimes it may ride on top of the EMA, so you may get like a railroad tracks that's literally going straight through the 50 EMA. These type 3 setups, most of them, they happen during the London session. You're going to look for the railroad track, star pattern, or cord of wood for the entries. Because it's a one-legged pattern, that's what you're looking for as the pattern reverses, right? To get into the trade. Is a railroad track, star pattern, or cord of wood. Most of the time it's going to be star patterns or railroad tracks. And same thing. Wait for a pullback to enter the trade. Wait to see if there's going to be a pullback. Sometimes there's not, but a lot of times there is. Especially if you get a really big spike. If you get a star pattern that spikes the middle of the range, that spikes sometimes by itself is like freaking 10 pips. So imagine the next candle after that that completes that pattern is another 10 pips or so. So getting a pullback is hugely important to get the best possible entry. Type 4s. Price action must make an aggressive move straight from the Asian session. You must have a pullback that gets stuck at the bottom or the top of the Asian session. These patterns are, again, typically one-legged patterns. These patterns happen during the London session. And the same thing as type 3s. You look for railroad track, star patterns, or cord of woods. The same thing as before. You always wait for the pullback to happen. When you start backtesting, you'll see why the pullbacks are so important. And then real quick, here are the exit strategies, which is pretty simple. Trade exits are pretty simple. Please do not complicate the trade exits. Okay? The goal is to take 30 pips per trade. That's the goal. 30 pips per day could be a lot to anybody. It really just depends on how much money, what's your balance of your account basically. 30 pips could be $3, it could be $30, it could be $300, it could be $3,000 per trade. The only thing that determines that is essentially how much money you have to trade in your trading account. So the goal is take 30 pips per trade. Now, if you have the EMAs in your favor, meaning you can use them as your take profit points, then you'll use them as your take profit points. So meaning if you're selling if you have a type 1 setup, let's say that you're selling and the EMAs are below you, so meaning the 50, 200, 800 EMAs are below you, you're basically using those EMAs as your take profit points because the price action will go to the EMAs. So if you can use the EMAs as take profit points, those are going to be your take profit points. Most likely, depending on how the setup is, it's going to be using the 200 EMA. If you're in the US session, likely it's going to be the 50. So if you can't use the EMAs, you're just going to aim for 30 pips. You can also, if you don't have the EMAs to use in your favor, is you can use previous structure, previous day high low. So look at the previous day's highs and lows. Where'd that happen? Right? When you use the indicators that we have, it'll print out the lines for you so you'll know where that is. Right? And you can use those for take profit points as well. because we know price goes back to those points. Okay, so you can use previous structure, previous days highs and lows, previous weeks highs and lows as take profit points. Some of these previous weeks highs and lows may be more than 30 pips. Doesn't mean that it's going to go past 30 pips. I'm just saying that you can use that as a target because we know that price does go to these points in reverse. If you want to try to write out as much of the trade as possible, meaning you want to go past more than 30 pips on a trade, you can do this by following the 5 EMA. And once it closes, above or below the 5 EMA, then you can close out your trade. So meaning if you're in a sell and you're selling it, you'll notice that price action is also below the 5 EMA. And typically it'll just keep staying below the 5 EMA, below the 5 EMA until it comes back up and it closes above it. If you're past 30 pips at that point, just take profit. What are we talking about? Again, have the mindset of we're here to trade for a long time. So the trade today will not determine my future, essentially. You know what I mean? So there's no one trade that you should be risking your future on. You have to learn, just take what the market gives you, call it a day. How many times have you taken a trade and you're constantly looking at it and you're worried about it? That's all you can think about when the trade is open. Start to focus in on the fact that you're day trading, right? You're day trading. So that means you should be in and out of the market the same day. If your strategy is a swing trade, then that's something different. But if you're day trading, take the money. Trust me. You'll love taking the money. You'll feel good the rest of the day. And you'll look forward to trading the next day. How many times have some of you guys taken a loss, or you've taken multiple losses that day, and the rest of your day goes to hell, meaning that you have just a bad day the rest of the day, solely based on the fact that you took 4 losses or whatever? Versus when you win a trade or 2 or 3 trades, what's your attitude the rest of the day? Pretty happy, I assume, right? Smiling from ear to ear. Can't wait to trade the next day, right? You're super excited. Can't wait to trade. So very important to take profit. All right, so let's go ahead and let's jump into the charts here. So let's go back here and let's take a look at some of these setups here. Here, for example, is a good example of a type 2 setup, right? You can see first leg here comes up, second leg, and then it goes. Notice how the candles are riding on top of the Asian bottom, right? They're not perfectly like up here, making the W up here. They're literally on top, riding on top of the line. That's perfectly fine. Okay? So what I'm getting at is I don't want you guys to confuse type 2s and type 1s. Type 1s, we clearly want price action to come and drop below here and do that. If it's riding the line, that's fine, still a type 2. Okay? Here is a type 3 setup. The previous day. So price comes down, comes back up, pins the middle of the range. What do you get? Railroad track. There's the 50 EMA riding on top of it. You see how this pullback happens here? Pay attention to this pullback. Do you see this? That's your pullback that I'm talking about. Right? So you're waiting, you see the railroad track, the next candle, wait to see if you get this pullback. Because this happens at the very beginning of the candle. Do you understand? So now instead of having a if we pull up the calculator, the risk to reward calculator, if you don't know where that is, on the left hand side of TradingView here, you'll see all the options, and you'll see here where it says prediction and measurement tools, and here you'll get an option for long or short positions. So this obviously would be a short position, so you click on it and then you could do that. Essentially the red is your stop loss and the green is your take profit, right? You can see how the numbers change according to what you use. So if you look at the difference, if you were to take the trade right after the railroad track, right, your stop loss would need to go above the railroad track, right? So this could be anywhere like, let's say 14 pips or so. And then because the EMAs are not in your favor, you're going 30 pips, right? So it'd be something like that. That would be the trade, right? You see how I mentioned before, where if you wanted to go more than 30 pips and the EMAs are not in your favor, right, then you can use the 5 EMA, which is the yellow line here. You could see you could follow it basically all the way down until it comes back up and it closes above, and then you can get out there if you want to. That would be 35 pips or so if you want, if you want to go up 5 more pips or so. But you could see the bigger picture of the move, you end up getting like something ridiculous like 88 pips. It's a six and a half, almost a 6.5 to 1 risk to reward ratio. And I want you guys to notice this. Look, every day, right? Every day there's something that happens, right? Look at what happened here. Asian session's only 16 pips. They went down, they came up, they come back down. If you're trading one-legged patterns like this, right? This might work out for you for 1 or 2 trades, but I know that in the bigger picture of you continuing to do this over and over and over again, you're going to have more losers than winners. Okay? Everything that I'm telling you that to do on here is literally based on all of my back testing that I've done. It's not hearsay, or it's not what somebody else says or anything like that. Okay? Yeah, the EMAs in your favor just means that you can use them as take profits. So in that example before here of, like, let's say this right here, this type 4, this is a type 4 right here, right? You see how the strong Asian move happens super early. You get like no kind of move at all, and then boom, comes back down, spikes the top of the range, and then goes back up. All of your EMAs that you would have are not there to help you take profit, right? Like, you're not gonna take a trade and then freaking take profit here. That doesn't make sense. You know what I mean? So when the EMAs are in your favor, I mean that you can use them to take profit. You know? So like for example, on this type 2 here, on this type 2 pattern here, you could have used the 200 as your take profit point, and you would have hit it in the US session. Right? The question is, do you have the stomach or the mental mindset to hold it that long? You know? Because I'm pretty sure as soon as you see this happening here, you're already freaking out. Am I right or am I wrong? But if you know the directional bias, then that won't bother you at all holding this, right? So let me just give you an example. For me, when I take a trade, I take the trade, I look at all the parameters, I make sure that, whatever confirmations I'm looking for are there, and I take the trade. Once I take the trade, like, I'm not sitting there in front of my charts looking at it. I literally go do something. I'm not worried about looking at the trade, because I know that if I lose the trade, I know what my loss is going to be. So why do I need to sit there and watch it? Because as soon as you watch it and you see this happening, you start to freak out and you get out of the trade. How many times have you gotten out of the trade to only it continue to go in your favor? So for me, whenever I take a trade, I look at all the parameters, I know what my risk to reward ratio is, and I'm okay with losing whatever I risk. Right? So I take the trade and I just walk away from the screen. I don't pay attention to it. I check in like an hour or two, So I don't worry too much about that. So like on this example here of a type 3, these EMAs are not in your favor because you cannot use them as take profit points. Okay? So when the EMAs are in your favor, you're going to use them as your take profit points. So here is an example of what a trade from the edge looks like. Here's your first leg. Here's your second leg. Right? So here's the pattern. There's your trade here. So the entry is here. Why? Why is the entry there? Why is the entry before the close here or any of these dots essentially? What you'll start to notice is that whenever you have behavior like this, so you have a huge candle, right? This is a huge candle. And then all of a sudden, you have this. Let me go back to that candle there. Think about what's happening here. You have two pretty big candles here that decisively is telling you price action is going lower, right? But you have price action just stops, literally stops. It's like, why are you stopping after two humongous bullish candles? Why is that? Why? And you just happen to be stopping here. Why not stop here or here? Why stop here? Why specifically are you stopping there? But then yes, you're correct. You get a railroad track. And so you could see that, this is a 4-to-1 risk to reward ratio. But this would be an example of a trade out of the edge, where the first leg of it happens to be in Asia, the second leg happens to be in the London session. And again, this railroad track happens at what time? Look at the time at the bottom of the chart. It's 4 o'clock. Now you're going to get stuff like this, right? Some days you're going to get a chart that looks like this. Understand that this is an example of a day that you may not trade. Right? The only possible thing that you can trade here is going to be in the US session, and that's basically going to be this down. The problem with this is because here's the problem that you're going to have is this candle here. This candle that tells you, hey, we're coming back down, is too big for you to get an effective entry with a good risk to reward ratio. Because if you think that you're going to get a good trade out of this, if you go short here, how big is that stop loss versus the reward? Like, that doesn't make any sense in you trying to take that. For you to get a good trade out of this, you would need a pullback to happen. And the pullback needs to be pretty significant for you to take this trade. I mean, you could see that literally even look how much of a pullback you would need. You need a pullback that almost the full length of the candle, right? So when I see this is a non-trading day for me. Yes, it went beautifully up, but you got to ask yourself, sometimes when you're looking at these charts and you're like, man, this went up, you know, how many pips did this go up? This went up 91 pips. Holy crap. I missed a 91 pip move. My question to you would be, where's the setup? Show me the setup. If you miss 91 pips, where's your entry? Point is that there's not. So you can't be upset about missing that when there was no setup to begin with. So understand that you're not going to have setups every day. Case in point, this right here. Next previous day, or the next day. Oh my God, it moved 100 pips in one direction. Holy smokes. I missed 100 pips. Okay? If you missed 100 pips, where is the setup? What's the setup that you're taking? Do not worry about what other people are doing. Don't worry about what other traders are trading, anything like that. Because at the end of the day, they're not paying your bills. They're not paying your electric, they're not paying your water bill, they're not paying your mortgage, they're not paying your insurance, nothing. So what they do doesn't matter. Don't ever compare yourself to somebody else, because you're completely different than the other person. So there's no reason at all to compare yourself to that person. I mean, I can tell you that on that day, or on this specific week here, right? This week where you had those two big moves where you didn't have a setup, that was Tuesday and Wednesday. You still had a setup Thursday, right? And you had a setup Monday. So you may have missed two moves that moved 100 and some odd pips, but you could have gotten 67 on Thursday and another 50 on Monday. So like, and there's also a continuation trade on Friday as well. And that was 55 pips also. So do not worry about what other traders are doing. Here's an example of a type 1, a multi-session type 1. See, price action comes down, gives you a first leg here, comes up, works this entire section here, and then rises above. What I want you guys to start paying attention to is start to understand the behaviors that market makers do. Do you ever wonder how somebody could have had a trade or could have gotten an entry that's like this? You ever wonder how people get an entry like that? The way that people get entries like this, okay, to be literally like this, is they start to understand what market maker behavior is. And they understand that once you start bringing in other elements to just the pattern, so you have the pattern here, but then you start to notice that it's pinning to the 200 EMA. Why are they pinning to the 200 EMA? You gotta ask yourself, why are they doing that? What's so scary that they don't want to go below that? They just spent the entire London session going down here. Why are they stopping? And every time that they attempt to go down here, they reverse, they reverse, they reverse. Right? So if you start to understand the market maker behaviors, when you start doing your back testing, you're going to see this stuff over and over and over and over again. You may not know the numbers that they need, but you know the behaviors because they do the same crap over and over and over again. And some of you, by the way, might see this as a type 3 as well, because it comes up and it pins the middle. And you get a little bit of a pullback here, right? So entry could be like this, 13 pip, and you end up getting over a 2.5 to 1 risk reward ratio. All of the trade setups, by the way, are 2 to 1, meaning that you should be risking 1 to gain 2. So if you're risking 15 pips, your target is 30. That's why the target is always 30 pips, because you're risking about 15 pips per trade. Okay? If you cannot get that, if you cannot get a 2 to 1 risk reward ratio, you cannot take the trade. The reason 2 to 1 is so important is because if you have 5 trades that you take and you lose 3, you're still in profit by just winning 2 because you took a 2 to 1 risk to reward ratio. So 2 to 1 or higher is hugely important. Do not take anything less than a 2 to 1. There's too many pips out here to be made to be taking 1 to 1 risk to reward ratios. It just does not make sense at all. Okay, so that's what a multi-session type 1 looks like. This is another trade out of the edge right here. First leg, second leg, and it goes. Notice the timing of the second leg. Same thing. It's 3:15, 3:30. This happens literally at the beginning of the session. Okay, in this particular example, you can use the EMA in your favor, right? Meaning you can use it for a take profit. Here's an example of a type 3 that actually has 2 legs. Right? So here it comes up, comes down, second time around, and then it drops. What do you get at your entry? You get a railroad track. If you do not like back testing, you're going to have a long time. I can tell you the difference back testing does compared to somebody who does and doesn't do it. It's night and day difference. It's literally night and day difference. On this one here, this is actually a continuation trade. So the trade here for me would have been this one in the New York session, not this one. But we'll talk about New York session and those specific trade setups for that session. All right, guys, so I hope you enjoyed that particular video on entry triggers and also exits. I hope it brought you some value. Again, if you like the content, if you like the series, guys, give me a like on the video and subscribe to the channel, and we will see you in the next one.